choose not to fly if prices were, and they wait for these are self-correcting mechanisms, and higher prices serve their function, right? To slightly decrease or dramatically decrease demand.
Yeah, we're gonna have to wait and see on that, because I think you know, people aren't going to be able to afford the flights the way that they're priced right now. Right. I think in the near term, I like Nathan's angle here, pushing that out maybe 6 or 8 months. Yeah, you expect travel to come back, maybe capacity will come online, but the inflationary pressures and wages, one of those things that never goes down, might be a concern also, and beating into that theme. Go ahead.
Tom, it looks like Wally World this summer for everybody. No flying.
Well, you can't drive either, Kevin. I'm paying $6 a gallon. All right, let's get into a stock that's actually doing pretty well over the last several years, especially since the pandemic started, pulled forward. Shares are up about 6% at Costco. You know, the company releases sales data every month, so you get some clarity on what's going on here, Nathan. They reported March sales up 18.7% from basically $21.6 billion. This company hit an all-time high today, above $603 a share, and you know, it just seems like the demand destruction for Costco isn't going anywhere.
Yeah, what a phenomenal company. And Tom, look at the chart of this guy from 2009 low. It's like a 45-degree angle from the bottom left to the top right. I mean, just an impressive uptrend here in Costco. And, you know, I'm really surprised they're able to do this, but then I think about it, I'm like, well, wait a minute. You go to Costco to save money on gas, and you go to Costco to save money by buying in bulk. And I think that's the allure in this current environment, and that's why they're able to deliver as consumers look for some way to save as they go and get their gas and groceries. So I think that perfectly fits that mold. What I will say, though, so they're at all-time highs today. So that's the bullish case for Costco. It's really hard to fight that uptrend. What I will say, though, what they're likely going to contend with here over the coming quarters, they're going to have tough comps that they're going to go up against. Right. The valuation is pretty difficult at 42. That's really high from a historical perspective for Costco, for basically a grocer, if you want to put it in that category. And the RSI right now in the stock is up at 80. And so, most viewers probably know, when you look at the RSI, the relative strength index, when it's above 70, it tends to be overbought. When it's below 30, it tends to be oversold. Another way to look at the relative strength index is to look at the historical RSI on that individual security. So if you look at the historical RSI on Costco, you'll see when it gets to this 75 to 80-ish area, you generally are going to encounter a near-term pullback.
Yeah, and I think if you get that PE moving higher. Now, one thing of note for this year, so historically every 5 years they've raised prices for their memberships anywhere from 5 to 10%. 2022 is the year, because the last hike that they did for those memberships was 2017. So that could throw some volatility in here. But Kevin, when you look at this, Nathan's point about, people are going to the gas station. I go by the Costco by me. I don't pull in, because there's a line of cars 30 deep here in Chicago, so I just don't go. But at the same time, they've expanded their e-commerce, right? They're into travel. They're into every item you can get online. So it kind of offsets maybe some of that demand destruction that we talked about. But buying in bulk, as Nathan said, is that the way that you have to look at this company, that they continue to grow, and every time you think that maybe it should stabilize or pull back a little bit, it continues to move higher because they keep on beating?
Yeah, if you remember, guys, March is about a year anniversary from the end of some of the stimulus payments. So for Costco to be able to keep these numbers growing, even a year after stimulus has run out, is pretty impressive. And Tom, here's the numbers. E-commerce was up 9.2%. Stripping out gasoline and foreign exchange, sales were still up 12.7%. These are big numbers coming out of Costco. And you're right, Tom. There's a Costco not far from my house. if you look at that Costco on Saturday morning, it looks like a scene from Mad Max. People are filling up their gas tanks. They're filling up pickle jars with gas. They're doing everything to get the cheapest gas possible. So yeah, it's a strange scene going on at the Costco near me out in suburban Chicago. So yeah, but these sales that they're putting up are just simply incredible, right? I mean, and their ability to keep this momentum going, because that was one of the big fears about this, was that they were going to see a drop off in some of the numbers. But Nathan also made what might be the most important part here, and that is this stock is overbought here on a relative strength. So even with these numbers, I'd be really careful up at these levels, guys.
Yeah, you mentioned that RSI, that indicator.
Yeah.
Just below the 80 level, so severely overbought, but that doesn't mean it can't continue to move higher. Nathan, when you look at an example trade in here and the run that it's had, maybe it does need to consolidate, or maybe it pull back just a little bit. What kind of strategy are you looking at here for just an example?
Right. Yeah, you guys, you know the common phrase in technical analysis, the trend is your friend. So it's really tough to go against that trend. However, timing is everything, especially in the options world. You know, I know you guys can attest to that. So when you look at the near-term overbought nature of the chart, as evidenced by that nearly 80, about an 80 RSI right now is what I'm looking at. If you believe that perhaps it might be due for one of those one-step downs, that's, of course, we're in an uptrend. You get 2 steps up, 1 step down, 2 steps up, 1 step down. If we're due, or if you believe you're due for a 1-step down, then it's hard to put on a bullish strategy right here, right now. So another strategy you might consider, if your belief that you get a near-term pullback, is you could look at something like a long calendar spread. It's not that capital intensive, and I was getting a little cute here with the expirations, but guys, I've talked about this on the show before. When you're initiating your option strategies in this type of environment that flips one way or the other based on headlines, and it can get very volatile overnight, the further you go out in time and you attempt to establish either a bullish or a bearish strategy, you got a lot of uncertainty to deal between now and expiration. So what I was looking at is just next Friday's a holiday, so next Thursday's expiration selling the 600 call, and then just going to the following week. This is uncharacteristic for probably a long call, calendar, but just going to the 22nd expiration and purchasing the same strike at 600. Last I saw it was about $3 debit.
Yep. So it's a 1 week wide call calendar, buying that April 22nd weekly 600 call, selling the April 14th weekly, or monthly actually, 600 strike call. It's trading roughly about $3.20 debit, and that's your risk on it, $320 per spread. Now your break-evens, Kev, you've got this up here. Break-evens are around 586 and about 615 to the upside, so you've got a wide range. So even if the stock does pull back a little bit, maybe goes a little bit higher, you still got a wide range. Kevin, your thoughts on a 1 week wide call calendar that basically expires in a couple weeks?
Yeah, what Nathan's given us here is a call calendar that actually, because of the price of the underlying, is actually a short delta. So remember, if 600 is your strike price and you get to pick whichever strike price you want, it's actually a short delta because it is slightly in the money. But remember, this is a call calendar with a range bound strategy. So the stock could go up, come back down, but net, if it doesn't move significantly over the next week or so, this spread, because of theta, can be profitable as long as implied volatility doesn't crash down, which is I wouldn't say it can't happen, but it's a low probability of happening, guys.
Yeah, and after that sales announcement, that implied volatility commentary that you just made, it's in the lower 1/4 of what we've seen over the last 52 weeks, which you'd most likely expect just due to the fact that the stock has risen to all-time highs in this session. But good look at an example trade that's relatively neutral, but still giving yourself a nice wide range on that particular option strategy. All right, Nathan, have a great day. Thanks for joining us.
You guys too. Thank you.
All right, that's Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. But coming up after the break, Kevin and I will be joined by Landon Swan from Likefolio for discussion on Roku, which is down nearly 50% just this year. Fast Market will be right back in about 2 minutes.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market on the TD Ameritrade Network. I'm Tom White, joined by my co-host Kevin Hinks. But let's bring in our next guest for our cash tag segment, and that's going to be Landon Swan, the co-founder of Likefolio. Thanks for joining us today, Landon.
Hey guys, good to be here. Thank you.
All right, so we're talking Roku. This stock's been taken to the woodshed, to say the least here, Landon. And I know you're probably not streaming anything. You're down in Florida. You're enjoying the weather. You're outside, hopefully. But, you know, this is the aggregator of all these apps that I subscribe to, right? You would think that it would be doing well, but this thing's pulled back over 75% from its all-time highs that we saw last year. Probably overbought at that point, but what kind of data are you seeing moving forward for Roku?
Yeah, so what's interesting is we're right back at pre-pandemic prices for the stock, right? So it's about 113 bucks in February of 2020, and that's where we're at now. A wild run in between up to just under 500 and back down again. And, you know, that was a case of the right place at the right time for this company, where people were not allowed to go outside pretty much, and you had to stay home. Of course, you're going to stream more TV. And so people were buying Roku devices, buying Roku smart TVs, using their channel. But now things are starting to sort of return back to normal. And unfortunately, the stock has as well, at least unfortunately for those holders. So when we look at how they did last quarter, you know, the revenue was very strong, up 33% year over year. The active accounts were up 17% year over year, up to 60 million. The number of hours that were streamed were up as well, 15%. By the way, I did a little math there. The average hours per day per account is 3.5. So a lot of streaming going on, and you got to remember that's per account. So that's not per person. I have 5 people in my family, so across all 5 of us, that kind of makes sense. We're looking at, though, the current quarter, and you know it looks strong. And if you have anything but that, you're going to dissipate that sell button, and I think that's what happened. Now, when we look at the company overall, how well they're doing with our data, it looks pretty strong. Again, happiness is strong, purchase intent is strong, but there is a little concern that Apple TV is starting to take a little bit of a chunk out of Roku's dominance. So right now, actually, Roku is about 1 in 3. It's the operating system of about 1 in 3 smart TVs. Apple TV is making gains there. They've got a higher level of happiness. They're doing better on a quarter-over-quarter purchase intent level, and so it's a little bit concerning. And I think one thing that's interesting is the fact that it's decoupled, right? So Roku is in smart TVs. You can still buy the device, but I think for the most part, people experience Roku because they buy a TV that has that in there. So they're impacted by a lot of the smart TV shortages and a lot of just issues around that. And you can kind of see how the smart TV usage has really trailed off. It bumped up in the pandemic, it trailed off. We're starting to make a little bit of a comeback, but for the most part, Roku is in the TV, whereas the Apple TV is also that external device. So they may be facing different challenges there from those two companies. The other thing that I would say is that's interesting is that streaming overall is down when you look at a year-over-year basis. Of course, you're comparing to when people couldn't really get out there as much. It's down 14%, you can see here. And if you look at the other topics that we're covering, just kind of polling social media here, subscription fatigue is up. People going out and going to the movies is up. That smart TV usage is barely moving. People talking about cutting the cord, which means getting rid of cable and getting a smart TV or getting a Roku type streamer is down. So there's a lot of things that are moving in the wrong direction. Now, this is year over year. So again, the comps are ridiculous. It's hard to compare to a year ago. We're starting to tick back up, but this is why Roku's been struggling a little bit as of late.
Yeah, Landon, this is a story of a stock market that has sold off and decelerating growth in Roku and higher interest rates. They, coming out of the pandemic, it went from a perfect storm positive to a perfect storm negative for this company. But the question is, because your numbers say it, the numbers that I have here say it, this company's still growing, and streaming is still at an embryo stage of its life cycle. So there's still nothing but opportunity. Is this story in Roku from $490 to below $100 before it firmed up here? Is this just simply a story of valuations and this new economy and the numbers that they took out of the entire market? Because your growth seems to be, a little bit of threat of competition here, but the growth numbers for Roku still really positive, Landon.
Absolutely. I think this is, they're clearly the leader in the space. They're a leader in innovation. They went from nothing to beating out Apple and Google and Amazon. That's incredible. Those are 3 monster companies, and they beat them at their niche category, right? So I love that Roku did that. And I would continue to argue that this stock is on sale right now. I think $490 was obviously a bit of a stretch, but I think that 100 or 115 or whatever we're at right now is also a bit of a stretch. And this is a company that is the leader in the space. They're getting a little bit of a threat from Apple, and of all the companies you'd want to be threatened by, that's probably top 3 that you don't want to be threatened by. So it's a little concerning that Apple's making some moves to take away market share, but they're ingrained in a lot of the TV, just how people think and how people operate. It's just second nature to click on the Roku button now, and they're getting in there. So I like them long term. Short term, obviously we need to find a bottom. The stock chart that you guys are showing there, maybe we're getting to a bottom. Anytime, if I saw a 90-something print, I would be buying shares for sure. Here, I'm a little bit inclined to, because I do think long-term they're going to make it. They're going to continue their dominance, but I think they just got a little outstretched on the valuation for a while.
Yeah, and I think that's part of it, because if you look at their growth rate, it still remains pretty solid, Landon. They're adding in digital advertising, which is starting to really pick up because they have this huge subscriber base. And as more people cut the cord, I know that some of your data showed that less people are cutting the cord, which may or may not affect Roku. But if you look at that, just the base that they have, even if Apple TV Plus is moving in a little bit and taking a little bit of market share away from them, don't they have other levers that your data shows that, hey, you know what, maybe overbought at $490, maybe oversold in the 90s, but at the same time, that's what you want. You want to invest to actually get a subscriber base so you can get that digital advertising and other revenue streams to start to ramp up.
I think that's a great point. And, you know, about that cutting the cord, it's down 6%. But, you know, if we had a chart on people talking about getting rid of streaming and signing back up for cable, I don't know that we'd have the sample size to put that together. I mean, hardly anyone's doing that. So maybe the rate of change from moving from cable to streaming is slowing down, but that's the direction that it's going. But you make a great point when it comes to the other revenue sources. So the Roku channel is at all-time highs as far as users. It's up 47% year over year on the last quarterly report, and they're getting advertising dollars from that. So it's not just the devices. That's not just the way they make money. They make money through advertising as well, and their revenue per user is up to $41. So they're doing a good job of monetizing those users. And you know, the Roku channel, I think, is one of the ways that they're demonstrating the ability to not only do the technology side, but also dip their toe into the content side. One final note, while the streaming is going down, mobile streaming is booming. It is up significantly, 46% on a year-over-year basis. So it is doing really well, whereas just overall streaming is down a little bit, but people are picking up their phones and watching shows on their phones way more than before. So just the fact that Roku is innovating and the way that their whole business has evolved over the years tells me that they're going to take advantage of that as well.
Yep, and I will not be cutting the cord anytime soon, Landon. I have all the streaming services, but I've also have the cord, and I'm not cutting it. And that's how I watch it on my mobile device. All right, great data as always, Landon. Appreciate it. Have a great day.
Thanks, guys. Take care.
All right, that's Landon Swan, the co-founder of Likefolio.com, breaking down the data for us on Roku. Kevin, and we talked about in the last segment that Costco overbought on an RSI technical level. I mean, Roku just bounced off of oversold levels as far as the RSI or technical levels go. What's your take here? And he was pretty positive because this stock has been reset. Maybe gives you an opportunity. I don't know if you're bullish on it.
Well, I mean, if at any point during this sell-off you like this company, you gotta love it down here. And, you know, spread. Going out to May 6th and April 14th, the calendar spread. And so that's about $4 because I want to give myself time for this stock to recover. But if it does start to move up towards that 50-day moving average, that would be around that 134 level. You know, this trade would do pretty well. Obviously, this is a bullish trade in terms of a delta. So, and you don't have a lot of theta. It's actually got slightly negative theta. Why is that? Well, because that move is a little outsized from where we have our options. So if it moves up at all, that theta will kick in. But where it sits right now, because that premium in that April 14th option is not very big. It's only about $0.50. You actually got a little bit of negative theta. Now, Tom, the more aggressive trade. If you think that this stock could explode to the upside, here's the 105. Now, I went out till April 29th. So the end of the month here, what's that, about 22 days. And I did the 105, 125, 1/2 back ratio, Tom. Now, that's trading about $4.70. So the break even on the downside, Tom, is only about $110. Or it's just slightly, it's about 109.72. is what the break even would be on the downside. So any down move of significance, and this trade would break even. But on the upside, Tom, if you look at the break evens here, and I'll set the slices to break even, you can see over 140. So if you get any big news out that's positive on this stock, you could have an extra call unit on the upside here, where the profit is, we love to say this word, infinite, Tom.
Right, so let's break down the call calendar first. About 29 days till expiration. Yep. Buying the May 6th weekly 135 strike call, selling the April 14th, which expires next Thursday, selling the 135 strike call in that option series. You're paying roughly about a $4.27 debit for that, Kevin. And you're going to capture that earnings event, which is about May 5th, I believe, on that particular trade. Your break evens on it, about 115 on the downside and about 160 on the upside for that particular position. So you've got a nice wide range. What you pay is your risk on it. So it's currently trading at or near about $4.10, so $410 per spread on just the calendar. So you want it to kind of hover around that 135, but you do have a nice wide range for that to trade in. But because you're buying that option series that has the earnings event, we should see, or we most likely will see, or historically we have seen, that implied volatility usually remains stable or goes higher into that earnings event. So that's a good look at that one as an example. And then the second one is a back ratio where you're selling one of the April 29th weeklies, the 105 strike call, and then buying two of the 125 strike call, collecting a credit of $4.75, which is the most you can make below that break even of about 109.70 to the downside, Kevin. You get to keep that credit, but where you don't want it to be is between that 110 and about 140, because you have that extra unit above 140, which gives you profitability to the upside at expiration. But you're collecting a credit on that particular trade. The downside of that particular position, Kevin, is right at that short one, or the long 125 strike, where you have the extra unit there, and that's going to be about $1,500 in risk per spread on that particular one. So you're playing for an outsized move, but you're giving yourself plenty of duration on that one, about 22 days or just over 3 weeks in that particular example trade. So good look at two different ways to potentially trade Roku based on Likefolio's data. All right, Kev, coming up after the break, we're going to take a look at Dick's Sporting Goods, which should be in focus with the start of baseball season today, and the Masters. Fast Market will be right back after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting
You can also take us on the go with our OS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. Stocks and stock index futures products are lower into the midday trade in continuation of the selling we've seen off the highs from earlier this week. Monday, the NASDAQ topped out at 15,268. Today, down to 14,337. The Russell's back below 2,000, leading the move lower, down over 1.5%. Fed minutes yesterday showed a 50 basis point hike at the March meeting was a consideration, and that the Fed plans to cut the balance sheet by more than $1 trillion this year. U.S. Treasury Secretary Janet Yellen yesterday warning U.S. lawmakers. She said Russia's attack on Ukraine will have enormous economic repercussions, all weighing on sentiment. The S&Ps are down over 0.5%. Crude oil to 93.81, selling off this week after a build in inventories. The U.S. dollar to multi-year highs, and the IEA, the International Energy Agency, announcing plans to release 60 million barrels from their emergency strategic petroleum reserves, all weighing on the WTI. It's down over 1.5%. Natural gas, on the other hand, spiking this week, back above $6. Just heard from the EIA. They said weekly natural gas inventories fell by more than expected. Analysts were looking for a draw of 26 billion cubic feet. Actual came in down 33 billion cubic feet. Also supporting prices, natural gas this week. Estimates that domestic production has dipped during a time when U.S. exports are increasing. This has been your TD Ameritrade Network Futures Market Update. Now back to Fast Market with Tom White and Kevin Hinks.
Welcome back to Fast Market. I'm your host, Tom White, along with my co-host, Kevin Hinks. Kevin, the Masters started today. Major League Baseball starts today. The hockey and NBA playoffs are coming up soon. And we've got a stock, Dick's Sporting Goods, that's right in the mix of all these sports. But the shares are down about 37% from those all-time highs that we saw last year. And this is one of those names, Kevin, that it makes me wonder how a stock with a PE of about 7 has short interest built up over 20% in this particular name. And people, for some reason, hate it at this point. But at the same time,
remember when sports Tom, a few years ago, it really threw this sector into kind of a tailspin. And there's been a little bit of lack of trust in this sector ever since then. But you're right. They've got a trailing PE in the single digits in terms of earnings. And this is a company that's putting up big numbers and growing. The only blemish that you could look forward in the future is something similar to Foot Locker, where what's Nike's commitment to these retailers going to be over the long period of time. But this company, you know, they're a multi-brand retailer. So Nike is a significant part, but not the only part of this business. So yeah, you're right, Tom. I look at a stock with a 2% dividend yield and a under a 7 PE. That is incredible for a company of this quality. But like I said, I think there's a lack of trust out there from the sports authority. Still a little bit of a hangover there.
Yeah,
Tom.
I think it's a hangover for retail right now, given the demand destruction that maybe inflation's causing. But if you look at some of the numbers, Kevin, 55% increase in revenue over the last 5 years. Gross margins have also increased in this name. So I wanted to look at this from a perspective that, you know, if you think that maybe this pullback, and it seems like there's some support around $95, $96 a share based on what we're seeing on the technicals for this. I looked at a strategy where I'm going to go out to the May expiration. So this is actually going to avoid earnings. Earnings are at the end of May after expiration. So this is the monthly cycle, 43 days till expiration. a little aggressive here, but this is a way for investors, if they don't want to buy the shares, maybe you want to give yourself a little cushion to maybe a neutral to bullish strategy, where I looked at selling the May 95 strike put and collecting a $5 credit on that cash secured put here, Kev. That takes your break even down to $90, where you'd have to buy them at expiration if Dick's Sporting Goods below 95 at expiration underneath that strike. Your take here on a cash secured put as a neutral to bullish type stance as an example.
Remember what you're doing here, Tom, because you're selling this 95 strike put, and it is a little bit aggressive, but remember, if you were to take delivery of this stock, your entry point would be 90, not 95, because you're selling it for a $5 credit. So there's added advantages, and if it doesn't get down to 95, you're collecting theta each day, Tom. So this is a little bit different. It's got the same profit graph as a covered call, but you don't get the dividend, so it's a little different, but still a very effective way to trade an underlying that you're in favor of anyway, Tom.
Yeah, and that 90 level as far as probabilities of finishing out of the money, and you mentioned if it's below 95 at expiration, you're obligated to buy the shares if you're still short that put at expiration at $90, right? That's your break-even point. That's right. A 65% probability that it's going to be above 90 at expiration in 43 days for this particular trade. Now, your max gain on this, Kevin, is $500 per put that you sell. Your risk is going to be $9,000 because if the stock goes to zero, you're going to, you're going to lose everything on that. You're going to have to buy those shares, right? It's going to go down to zero. So to your point, it's almost like being long the shares below that at expiration if you're obligated to buy the shares at the $90 break-even point. But great look at a cash secured put if you think you have a bullish stance or it's going to remain here above that 95 strike into expiration over the next 43 days. All right, Cav, that's going to do it for us here on Fast Market. But stick around right here on the TD Ameritrade Network as Next Gen Investing's coming up with Alex Coffey and Jenny Horn hosting.
Wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
It's a 13-hour flight. That's not a weekend trip.
15 minutes
Oh,
away.
wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
And manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
New York Stock Exchange, only on the TD Ameritrade Network.
Good morning, ladies and gentlemen. It's time to talk futures here on the TD Ameritrade Network, and I'm your host, Ben Lichtenstein. It's Friday, April 8th. We've got lots to cover, so let's get started right away without delay, just like we do every single day. First, a look at Asian markets going out positive. The Hang Seng, the Shanghai Composite, and the Nikkei across the board here enjoying some gains into their close this Friday. Take a look at where things stand in terms of the DAX and the FTSE as they head into their midday trade. European markets also enjoying gains, much like we're seeing here in the U.S. The four major the Dow holding above 34,000, the Nasdaq below 15,000, the Russell briefly below 2,000 this week. So a couple psychological levels to keep an eye on there, but let's also check in on some of the other top traded products that have been on the move this week. For the matter, the dollar. Take a look here. It's been to, well, levels we haven't seen since May of 2020. We're just shy of that 100 even level. Take a look at gold, parked at 1930. Crude's holding below 100, and well, the VIX here right now down by about 0.5%, so kind of limited activity in terms of volatility as the indices have been trying to rally back here. The VIX is still holding above 20, but let's take a look at what's behind some of the price activity we're looking at this morning or there, and what's on the minds of traders and investors as we get things started. Squarely on inflation, the role the war on Ukraine's playing on consumer price pressures, and well, let's begin with the move in the longer end of the yield curve yesterday. First and foremost, the TYX, a 30-year up and through 2.7% with treasuries selling off. Take a look at the bonds here, first and foremost, down to 143.25. And, you know, I just want to point out zero rejection of these lower levels as of yet. We've been talking about that throughout this trend to the downside and how we've really yet to see any V-bottom type rejection. We continue to see value form at lower and lower levels. And well, the interesting thing is it was the longer dated yesterday. You can see it now, the 30-year in the top left corner. Look at the 10-year in the top right corner. So the longer dated on the top half of the screen. And while the shorter dated had been leading in recent weeks and months, more closely tied to the Fed, it's a little bit of a laggard here as of the tail end of this week. You can see, again, just pointing out how the longer dated leading the way to the downside. Take a look. This has the 30-year up to 2.71, as mentioned, up and through 2.7. The TNX 2.67, and look at the 5-year at 2.76. Now, 10-year Treasury yields hit a new 3-year high, now up 114 basis points this year after ending 2021 at 1.51%. 1.51%, directly tied to crude, holding up around this $100 barrel level. Commodities in general, for that matter, at elevated prices, and the ongoing war on Ukraine. Possibly adding to the pressures this morning, we have the EU, which has agreed to ban Russian coal imports as well as Russian ships and trucks from entering ports. The UN Assembly voted to suspend Russia from the Human Rights Council as a result of the atrocities committed in Ukraine. And the UN Food Agency this morning, well, they said that world food prices jumped to new record highs in March. The Food and Agricultural Organization Food Price Index, which tracks the most globally traded food commodities, averaged 159.3 points last month. That's versus an upward revised of 141.4 from February. Now, the February figure was previously down at 140.7, so the revision up to 141.4, a record again. Now, up 12.6% from February of 2022, a 33.6% increase from the March 2021 level. So it's not just energies. We've been talking about this, grain prices in general, commodities for that matter. Let's take a look at the indices because they are shrugging off some of these concerns here this morning as we get set for the cash open. I wanted to point out the bid we saw off the lows from yesterday and the move higher as we get set for, again, this morning's opening bell. Take a look here, first and foremost, at the ES, the 5-minute time frame. And I wanted to point out how we sold off to begin the day yesterday, down below 44.50 and a sharp move higher. You can see the migration of value to the upside here, separated by the vertical conviction. This is a textbook rally here, again, rejecting these lower levels and sideways consolidation here at right around the 4,500, 4,505 level. Take a look, a very similar pattern playing out in large caps. Yesterday rallied back from, well, just barely holding on to that 34,000 level. Again, a similar pattern, high conviction trade to the upside into the close, closing near the highs and basically rejecting that lower level. Similar pattern in the NASDAQ. They got all the way down to 14,317. As I mentioned at the top of the show, still shy of 15,000, but a strong move up and up 0.25% as we get set for the cash open this morning. The Russell enjoying gains as well, up 1/3%. And, you know, again, holding back up above this 2,000 level. Look down to 1978.80 yesterday. Let's step back from the 5-minute time frame. Take a look at the ES off the all-time highs from 48.08 beginning of January, if you remember, down to 4,100, well, 4,101 as we saw the lows from February. Want to point out throughout the month of March, the rally that we saw off the 4120, 4130 area, rallying all the way back to above 4,600, taking out those Feb highs. And I do want to point out, unable to see follow through, though. We're starting to come off a bit. It'll be key to watch here now if that bounce we saw yesterday can get some legs, can get back up above and through 46, for example. Ultimately, the bulls want to see us take out those highs that we saw to end the month of March. And I think to the downside, you've got to be focused on 4,100, especially if we build energy. Well, if we roll over here, if we build energy through 4,400, 4,350, 4,300 to the downside, it opens up a door for a retest of that 4,100 level. We'll continue to watch rates and some of the other fundamentals that have been weighing on sentiment. Speaking of weighing on, well, you can see how the ES has rolled over on the daily time frame, nearing that 50-day moving average. And I just wanted to point out where things stand in terms of the 200-day. We're holding above it. And take a look here, guys, as well, you can see the Russell's below it. So, again, a little bit of a divergence there as small caps have been coming under pressure. They're back down below that 2,100 level, as I mentioned yesterday, briefly below 2,000. And, hey, this has the VIX on the move this week, to say the least, from 20 to 2560, all the way back down to, well, we're currently at 2286 right now, 2288, I should say, slightly lower, as the indices, again, are up by about 1/3%. Just a quick look at where things stand in terms of the VIX. Throughout the month of April relative to the month of March. Here you can see we've been holding near those lower levels again as we took out those Feb highs again into the end of March. And while follow through for the most part has been somewhat limited in April, we really have yet to start to work our way lower, just kind of hanging out just under that 4,600 level here in the ES. Again, as mentioned, at 45.08 right now, currently holding again these levels. So it's a good look at where things stand in terms of top stories, what's on the minds of traders. We get set for the cash open this morning and a few levels in the indices to keep an eye on. Let's shift gears. Let's talk commodities, specifically grains, ahead of today's WASDE report. Our first guest this morning, Jake Hanley, joins us, the Managing Director and Senior Portfolio Strategist at Tecrium Trading. Jake, Always great to have you on, and happy Friday. Welcome. Let's just,
Thanks,
I was mentioning at the top of the show about how the impact from the war on Ukraine's had, world food prices jumping to new record highs in March, according to the UN Food Agency, and basically proof positive the fact that it's not just crude prices, it's not just energy markets. This is a widespread situation we're dealing with.
It absolutely is, Ben, and it's very sad to see things developing this way. As you look to Peru, for example, I mean, they are having riots in the streets right now. Basically, they're dealing with extremely high food prices, just as countries across the world are. And, I have to point out that some comments have been made about global food shortages. And it is certainly true that higher prices work to impact food insecure nations such as Peru. Major wheat importing countries are likely to see some political unrest, and that is really, really unfortunate. However, it's key to remember that the world has enough food. It's a matter of getting that food to where it needs to be. And high prices have an impact, absolutely. But critically, for us in the United States, we are not going to see food shortages here. And I'd really like to point that out because I've been seeing that floating around a little bit. And frankly, my fear is that that narrative gets out there and we see a run on food like we saw a run on toilet paper back during the COVID lockdowns, okay? And we are not in that position in the United States.
I think that's important. Jake, talk to me about, some of those countries, India, for example, very dependent on Russia in terms of grains.
Yeah, that's absolutely true. And, I think as you've been talking about on your program and we've seen in the media, this idea of deglobalization, as that's happening right now, people are coming to terms with the fact that commodities are the ultimate reserve currency. Okay. And so you can see that in the ruble. The ruble is back above its pre-war highs. Why? Because Russia is a commodities rich nation. And if you're not a commodities rich nation and you're dependent on commodity imports from other places, you're in a precarious position right now. And so the United States, we are blessed here in America. We have abundant natural resources for energy, abundant natural farmland to produce food. And we are exporting. And one of the things to watch for on today's WASD is export expectations and increase for export expectations from the USDA because we know that people need this food. They're not getting it from Russia, Ukraine. There's a lot of food locked up in storage right now that can't get out, a lot of wheat, a lot of corn. And so a lot of that demand is going to come to the United States. And we'd like to see that reflected in the WASD.
Corn currently up on the day right now by about 0.4%, hanging out around 760 as we get headed into this release this morning, a little bit later on this morning. And it's been in a bit of a range. Talk to me about what we're seeing in terms of planted acres. In your notes, you mentioned more acres are going to be dedicated to soybeans versus corn this year.
Yeah, that was a surprise. The markets were surprised to see that. That's the prospective plantings reports. So those are expectations. If that plays out, Ben, that's only the second time in U.S. history that U.S. farmers have dedicated more acres to soybeans versus corn. And on the surface, that is, supportive for corn prices. And as your chart just reflected that, we're in a situation where if that plays out, we may see the stocks use ratio, okay, that is the corn that we have in inventory versus demand expectations, below 10% again for the 22-23 crop year. That means a tightening situation for U.S. corn supplies, whereas we'd really like to see corn supplies, increase. And so a tightening balance sheet for domestic U.S. corn is further support for prices. Furthermore, with soybeans, planting additional soybean acres is helpful, but it isn't necessarily going to alleviate the world's soybean supply issue. Okay, we know that South America's had a tremendous issue with drought. Expected production there is estimated. 30 million metric tons or more in South American soybean production that disappeared. And so, soybeans, it's hard to say, if prices, how much higher prices can go from here for all these commodities. We are at high levels. So anyone's guess how high they can go from here. But I think it's fair to say that the downside is relatively limited. even with planting as much soybeans as we're looking for in the U.S. this year.
You said in terms of the WASDE report today, keep an eye on the export expectations, but in your notes you also mentioned that you're expecting slightly lower ending stocks for corn and beans.
Yeah, the USDA is expected to lower ending stocks for U.S. corn and beans on this report. Usually April is kind of a sleeper report. Next month, Ben, when we're back on, we'll be talking about expectations for the 22-23 crop year. That's the first WASDE report that we get that gives us the official USDA numbers for there. So a lot of what the market is trying to price in right now is based on that 22-23 crop year. Sure. And unfortunately, we have to wait another month to get those estimates.
Talk to us about weather, always a factor when you consider grain markets. It's not just some of the pressures we're seeing right now in terms of Ukraine. I mean, ultimately, you have to revert back to the fundamentals that for years have proven to be time-tested and proven to be factors to consider as well.
Yeah, you're absolutely right. And last time we were on, we brought up weather, and the market is focusing on weather now. We are planting corn and soybeans. That has started in the United States. Planting conditions look good so far. No expectations of planting delays or major planting delays. That said, we are starting the year with about 31% of corn growing areas experiencing drought. When you start a planting year with dry conditions, that means that you need some alleviation down the road. And so looking at the long-term forecasts, NOAA is still showing that June, July, and August are expected to be drier than normal and warmer than normal in the majority of the Farm Belt. And so watch the weather very closely here. Okay, this U.S. crop is very critical this year.
We've been talking a lot about beans and corn. I just wanted to pull up the wheat chart to just point to the fact that, again, in terms of the commodities, this one's been participating as well to the upside. Jake, talk to us about what you're seeing in terms of demand for the ETFs. We had been talking about the record demand for the beans ETF. What are you seeing here as far as of recent?
Yeah, Ben. So, actually, I'd expect to see more demand for beans. The fundamentals for beans and corn, as we just described, have been tremendous. Wheat has been getting record attention, and that is tied directly to the headlines out of Ukraine. We've talked about the fact that Ukraine and Russia combined for 30% of global wheat exports. The Black Sea is basically shut down. There's a lot of grain stuck in storage in Ukraine right now. And Ukraine's a major wheat exporter. So wheat's been getting a ton of attention. And as you look at those price charts, you can see that wheat has behaved differently than corn and soybeans. And it's basically because of that headline trade there with that initial spike. And so continue to watch wheat prices. It's going to be interesting to watch as grains are stuck in storage in Ukraine. Literally, you can't get this grain out of the country the way they would like to. That supply that's stuck in storage will show up on balance sheets as being there. Okay? Those ending stocks will be there.
But we can't get it out.
But you can't get it out.
Right.
Exactly right. And so, you have this weird conundrum there. Also, Ukraine, they're going to harvest their winter wheat crop shortly. And if there's no storage capacity, then you're looking at a real problem.
Well, lastly, real quick, Jake, are they going to be able to harvest, and ultimately will they be able to plant again, considering the destruction we've seen?
Yeah, that is remains to be seen. They are planting, not to the extent that they normally do. I saw something that says planting is going to be down about 80% from what it normally is, and we've seen just reports of fields that have been left a mess, mines being planted in some fields. I mean, a real mess and disaster. So we'll see if they can do it. It's great. But again, you got to be able to get it out.
Yeah, I've heard the same, a dangerous situation to say the least. And I apologize, a good reminder, I said the beans had seen the record demand. It was for the wheat ETF, WEAT. Again, Jake, always a pleasure to have you on the show. Appreciate you helping us out to get ahead of the WASDE report this morning. Jake Hanley, Managing Director and Senior Portfolio Strategist at Tigrium Trading. We're going to take a quick break. Thanks to you, Jake. Stick around. We're going to come back with more future. Sean Cruz joining us to get ahead of what's to come. Focal points for traders and investors as we engage and begin the cash trading session here this morning. Still more after this short break. We'll be back.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially help the trader choose between them. We also designed to harness changes in implied volatility. For instance, time spreads, like counters and diagonals, are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Welcome back to the Future Show here on the TD Ameritrade Network. I want to shift gears and move away from the commodities discussion and the inflation concerns that we've seen in terms of the root of the problem to a reflection of the problem and how we've seen rates on the rise, a big move up in the longer end of the curve yesterday. For that discussion, we have Larry Shover. He's the Chief Investment Officer at D. Alexander Capital. Larry, good morning to you. Happy Friday. Thanks for joining us. We have been keeping a close eye on the short end of the curve. I wonder now if after what we saw on the 30 and the 10-year yesterday, that's going to, attention should now be directed more towards the long end.
You know, I'm not really sure about that, and I don't think the market is either. I mean, right now it seems like monetary policymakers and risk assets are comfortable and think that we'll have a soft landing. But when you look at the yield curve and whether it's negative 9.5 or plus 15, I'm talking about the 210, it says it's something different. So right now, it seems like the long end, the bearishness is in place, and there's still some room to run. And I think investors are not right now fearful of missing out on buying duration at this point.
You know, we were just looking at the 5-minute time frame, the move up that we've seen on the intraday, and here's a look at the daily time frames, the weekly time frames to get a bigger picture idea. You can see the 30-year on the left, the 10-year on the right, the spike up to 2.7 for the TYX. You got the 10-year at 2.68. Larry, we've seen the dollar on the move as well, higher reflection of this, whether you're talking about that safety type trade as the indices have come off a little bit after taking out the Feb highs into the end of March and kind of teetering a little bit here, it seems like, below those levels as we started off the month of April. But amidst some of the geopolitical concerns, which while they may have diminished a little bit, definitely have not been removed.
No, not removed at all. And the dollar index itself, I think it's up a little bit over 1% over the last 5 days. And I think a lot of it is safe haven, but the other has to be the balance sheet details that the Fed brought out on Wednesday. Even though most of that seemed to be baked into the market, I think at the end of the day, it represents a meaningful milestone. And, given that the mystery of SOMA is reduced, the market's now left to guess what the consequences will be. And I think that's what we're seeing in the dollar, and also, to an extent, the long rates, the 10, and especially the 30.
Yeah, I want to just pull up this chart here of the dollar and the move higher that we've seen. Again, similar to what we've seen in terms of the indices. We've seen throughout the month of March a strong run up in the indices. The dollar actually started to firm up as some of the Fed speakers became a little bit more hawkish, a bit more apparent that we were going to potentially see that 50 basis point rate hike. And recently, again, up and through this 99 level here, and it is yet to look back, again, nearing that 100 even level. I just want to remind our viewers, for those of you who don't have access to the dollar index futures, I've got that on the left here now, and we're actually looking at the weekly time frame, so you can see the run-up since the, we're talking lows that we saw back in the beginning of 2021. But you can also remember to pull up the $DXY, so that'll get you access to the index. Larry, in terms of some of the other foreign currencies, you talked about the kind of reaction that we saw to some of the comments from the minutes this week. I mean, I guess I wonder, where does that leave the ECB? Everybody's been talking about how they've been behind the curve for a while. Does this accelerate their expectations in terms of their stance on rates any?
Yeah, I mean, it's been a mess this past week, because you're right. There's been so much commentary about them being behind the curve, and also us being behind the curve, especially what we heard the other day from Bullard.
Well, he said we are.
Yeah, he said we are, and he wants to see 3 to 3 1/4 by the end of the year. They're in maximum hawkish mode. I think ECB wants to be in hawkish mode, and that's their desire, and it could happen at some point. But with regards to being a lot closer to Ukraine and also dependent on Russian gas, et cetera, the closer you are to that situation, the harder it's going to be for that currency. And so the negative risk premium is built into the euro, at least versus the dollar. And we know that could spring and reverse at any point with regard, given any kind of good positive developments in Ukraine. But right now, ECB kind of has to be on hold.
No question, and a very good reminder there, Larry. Oftentimes we forget to do that, and it's important to keep in mind that these geopolitical tensions, while they bring in premium or create a situation, again, where they weigh on the euro, for example, that's present. But should headline news in a headline-driven market come across that kind of goes against that, counter to the trend that we've seen, you get this really sharp snapback oftentimes as everybody's positioned in one direction and needs to get out. Speaking of the EU and the euro currency and feeling some of the weight of what's going on in Russia, ultimately, we've got these new sanctions as well we were talking about at the top of the show. And it seems like, again, this morning, if anything, that's kind of weighing on things as well. It looks like if lower today, down 7 days in a row here, the euro currency, that is.
Yeah, and it's something we spoke about a few weeks ago. If this persists, it's just going to hamper any kind of effort by the ECB to do anything with regards to monetary policy. And so that said, it's just maybe not a free fall, but we're just going to see a ratchet down of the euro currency, especially versus the dollar, given the proximity of Ukraine versus the dollar. And that said, we know it can reverse right away. But right now, it seems that this whole thing with new sanctions on coal and perhaps even oil, that's going to just put a lot of negative pressure on a currency that already has a lot of pressure on it.
Speaking of oil, this week, it seemed like the focal point was here you can see the 60, the euro currency, which has been coming off. Now, this is a look at the weekly time frame from the 112 handle, beginning of the year 2021 all the way into. So we're looking at the last year and a few months here. Larry, speaking of oil this week, it seemed like the focus was on, well, we heard from the IEA, they actually did move forward with the strategic petroleum reserves, kind of following up in terms of how we closed out last week with the U.S. announcing that 180 million, I think it was, 1 million barrels per day for the next 6 months ultimately. So this has eased some of the pressures. It seems like crude's back down below 100 as we head into the end of the week. And while not necessarily at the 40, 50, 60 level we'd like to see, as we were talking about yesterday on the show, well off the 130, and a reflection of how some of those price pressures have eased a little bit. My concern here, and talk to me, kind of ease me back off this edge here, is that with these new sanctions and everything, we haven't really heard from Putin much over the last 2 weeks now. I wonder if things are going to start to boil over and all of a sudden we'll get some sort of a snapback response from him.
Yeah, I mean, we're all hoping so, something that's, that's positive that will change things in a hurry. But the fact is, damage has already been done because we're in a season now where, getting into high driving season, getting into just finishing refinery maintenance season, a season when we should be filling, and we're definitely not. Now, this last EIA report we did, but that was a one-off report, at least with crude. With gasoline, we saw a significant draw. But that said, I think one thing that's buffering us right now, sad to say, but just the magnificent restrictions that are going on in China right now. I think that's really helping. I mean, there's estimates that that's saving 200,000 barrels a day just for Shanghai alone. So the world market doesn't have the demand that we did last time that we saw the IEA release reserves. So I think we're seeing a different reaction, and it removes some of the positive price risk premium in the price, and that's why we're seeing it down around $100 a barrel.
When you're talking about restrictions in China, you mean Shanghai lockdowns and how they've been, well, it sounds like this week extended, Larry. Yes, it was extended, and so the world demand has fallen off quite a bit, and it's no one wants to see these lockdowns and COVID extend itself, but for the price of oil, it really has helped reduce the volatility a little bit because demand is not nearly what it should be, given we're in April right now. Yeah, and I'm looking at the numbers here from the report on Wednesday, and well, here you can see crude oil back down below $100, again at 96.97, but the report on Wednesday, gasoline production was up, while, again, you mentioned the EIA, the crude oil build in inventories, but gasoline inventories were actually down by 2 million, basically as much as we saw an increase in the inventories, and they were looking for a bit of a draw in the inventories. Larry, just quickly, final thoughts in terms of next week, retail sales, CPI, PPI, a couple focal points for traders and investors to prepare for. Yeah, we have two big things to supply, 34 billion 10-year, a 20 billion 30-year. That's really going to affect duration. It may affect it today, but Tuesday CPI is really important. Is inflation running hot? And what we have to keep in mind is, like, are we going to see a divergence between headline and core? I think headline is expecting 1.2 and core plus half. That said, why it's important is that if food and oil persist higher because of Ukraine and core moderates, that could very well change the Fed's thinking on persistent 50 basis point hikes. I'm not saying it will for the May meeting or even the June meeting, but going forward, if we see that divergence, because core up 0.5 percentage point, that's what it was the month before. If we continue to see that moderate versus the headline, that might be a signal that the Fed will not continue to be in full hawkish mode. So a very important report to look at, especially as we get into April-June series with yields, continuing to go higher. Okay, the mindset being that they're willing to kind of discount some of the geopolitical premium that we're seeing come into crude. Okay. Exactly. Yeah. Food and energy persisting while the core moderates. That might be a signal. Larry, you're giving us something to keep an eye on as we head into next week, and a good explanation in terms of what's been playing out this week. Larry Shover, always appreciate you joining us here, the Chief Investment Officer at D. Alexander Capital. We're going to take a quick break. Stay right where you are. You're properly positioned. You're watching the TD Ameritrade Network. We got lots more futures coming up. Sean Cruz joins us after this short break.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to the Future Show here on the TD Ameritrade Network as we get set for the cash open this Friday morning. We've got the U.S. stock index futures products for that matter, suggesting that we'll see a higher open here today. Let's check in on where things stand in terms of the ES, the NASDAQ, the Dow, the Russell, enjoying gains. Are up, well, 0.2% across the board or greater. And here you can see, again, actually now just 0.1% for the NASDAQ as it's pulled back just a little bit. But you can see, again, all four majors here in positive territory, holding on to some of the gains that we saw yesterday, a big move up off the lows. It's from the day session trade yesterday. Let's take a look at some of the other top traded products as the dollar inches higher here this morning. We're talking into levels that we haven't seen since the spring of 2020. It's the upper extreme of this 99 handle, and, well, 99.99. It's up 0.25%. Gold's holding on to the 1935 level. Crude's below 100 at 96.88, and, well, Bitcoin hanging out right around 43,400. Now, I want to take a closer look at the VIX there. You can see at 22.95, it's been coming off recently off the highs that we saw in March, up around 36.50. And to help us take a look at the VIX and how investor sentiment concerns have eased a little bit here in terms of some of the unknowns that we were looking at into the beginning of March here. Sean Cruz joins us, contributor here across the TD Ameritrade Network. Sean, good morning to you. Throughout the show so far, we've been talking about inflation concerns. We took a look at commodity prices from a couple different angles ahead of the WASDE report today. For example, we were talking grains and the impact that some of these sanctions have had and Russia's war on Ukraine across the board here, though, whether you're talking energies, corn, wheat, beans. But, you know, we also talked a little bit about the VIX coming off and back down to this 20 handle, briefly below the March lows to begin the month of April. A reflection of that, though, treasuries, the futures coming off. I mean, oftentimes if investors are concerned about what's playing out geopolitically or in the indices, stocks in general, you'd see the treasuries getting a little bit of a lift. We're not seeing that. It does seem like some of those concerns have eased since the beginning of the March, my point here.
Yeah, I think so, and I think I think people view treasuries also. You know, we like to just focus on one rate, but there's a massive complex out there that actually trades treasuries more as a long short, as a spread type of a trade. And I think the market's telling you that inversion we had recently was maybe a little bit overdone, but you're starting to see the market now come in, and I think just some of the traders, the trade volumes and flows into sort of that steepening trade is probably driving a little bit of that correction. And I think it's worth noting now, if you want to look at and just see where treasury futures are heading, and you can look at the 10-year, you can look at the 30-year if you're looking a little bit further out.
We have them both here right now. We're looking at them side by side.
Yeah, so if you're looking at that and you take a little bit of a step back and say, okay, well, when was the last time we were down at these levels? It was around 2018, and at that time, that's when we saw the 10-year drift up towards that 3% level. So I think it's giving you an idea that maybe there is a little bit more room to run higher here out of that 10-year yield if we continue to see inflationary pressure. And I was just listening to Larry, and he's looking at some of the inflation data that's coming out here next week. But we also have some really important data coming out of China as far as inflation goes as well, and also some import-export numbers. And you were also mentioning the sort of the widening and extended lockdowns that they're experiencing as a result of China's sort of zero COVID policies. Things like that, I think, are going to be worth keeping an eye on. We actually have a lot of auctions next week in not only our treasuries, but we also have the 10-year German Bunds going to be getting auctioned off. The auction I'm actually looking at, and I think people might want to pay attention to this one a little bit more than usual. On Monday, we actually get a 3-year note auction. And the Fed really sees the 10 and 30 or some of the areas of the curve that are a little bit further out as a little bit more speculative, but they view anything about 5 years in on the Treasury curve to be a little bit more accurate in terms of what it's pricing in for policy. And the 3-year note is actually one that it doesn't get a lot of headlines. We usually focus on the 2, but the 3-year tenor is probably something that you want to keep an eye on when you have so much uncertainty up in the air around exactly what the future path of Fed policy is going to be. That'll probably play out, or you'll probably get a little bit more of a refreshed idea from a lot of the participants that come into these auctions on exactly where they're pricing these 3-year treasuries at.
Okay, we'll keep an eye on the 3-year next week, in addition to some of the other durations, the longer dated. Now, in terms of the short versus the long end, we talk about, again, the 3, the 5, the 2, and how they're more closely tied to the Fed. To your point, they're trying to get a gauge in terms of where the Fed's going to be at the May meeting ultimately. But yesterday, the real move seemed to be in the longer end. It was the ZN, the ZB, the TYX, the TNX really kind of kicking into gear and sort of picking up some of the slack. They've been kind of lagging for the most part throughout this, creating that situation, as you mentioned, the yield curve inversion. And I don't necessarily debate that right now, but I guess I'm wondering, with the longer end starting to join in right now, what does this tell us about the likelihood or lack thereof of a soft landing?
Yeah, I mean, I think you're happy to see the 10-year and that curve move out of inverted territory, and I think a lot of people out there, I think the big debate is, well, does it have to, be there for a month, or is there some sort of time period that needs to be there? Yeah, and I think that is, to me, I'm even in the camp that I agree. It's certainly not a good sign just to see it flattening out the way it is, much less inverting. But I think there was probably just a lot of flows behind that move that we saw in the Treasury curve.
Maybe a little overdone.
Yeah, it got a little overdone, and I think it quickly reversed itself. And the other thing I look at alongside that is, if you just look at the CME as the Fed watch tool, where they sort of show where things are getting priced out for the future expectations of where the Fed's going to be at for the policy rates, and that tool has been all over the place. One week it's pricing about a 70% probability of being at 50 to 75, and then a few weeks later, now it's a 70% probability of being 75 to 100. I mean, it's been moving quite a bit. So I think you're just going to see a lot of volatility and just a lot of weird, funky things coming out of the Treasury curve when you have expectations just kind of all over the place the way they have been.
And unknowns for the most part. It makes me think back to a few months ago when we heard Janet Yellen, as they were kind of trying to sort through all of this COVID information, and she was basically saying, look, we're going to see some supply chain relief once the COVID numbers go down. Ultimately, that could equate to inflation kind of easing. So she sort of tied the inflation to COVID numbers. But now we've got this whole new factor when you consider sanctions, ultimately not something that she even really saw on the horizon at that point, probably. So you've got a different situation right now where it seems like, and I guess I wonder, with that being the case, again, maybe we could take rates to the upside, inflation to the upside tied to COVID, and sort of pull COVID out and maybe replace it with sanctions, even though now I think of it, as I say it, COVID numbers for the most part have been on the rise again as well, many would argue, here in the U.S. and globally for that matter. But it does seem like sanctions a major factor to consider when you're talking about rates to the upside.
I think so, and that it really is. I think you can just lump all of that into just sort of, once again, supply chain issues. And we got used to COVID, those issues being, things getting held up in ports because they can't have enough workers there, or manufacturing centers in China having to completely shut down, and now manufacturing is taken offline. I think what you're doing now is what the situation with Russia and Ukraine is doing, is sort of taking those bottlenecks or sort of that shutdown or whatever you want to call it, and from manufacturing and shipping, and just moving it further upstream to those base core commodities. And that's why that's so much more troubling, because that's sort of, you're going way up the river and sort of damming things up. It's going to affect everyone almost everywhere. So I think right now what the market is probably looking at, and you talked about VIX being where it's at these levels. I actually think these levels look a little bit low going into an earnings season, where I think we are going to hear some pretty wild things all over the place from a lot of these CEOs. And I think previously we were used to anybody that had chips in their product or service. Those were the areas we knew to focus on for supply chain issues. Now I think it's going to be everywhere. Every sector, every company is going to have to address their supply chain issues, their input costs, and how that's affecting profitability and their bottom line. And I think a VIX down here, it's still north of 20, which I think shows the market is paying giving some respect to that. But I think a VIX down here at these levels, when you're going into such an uncertain period where really no company is going to be spared, seems a little bit lower than I would have expected. But look at the Treasury, or the inflation data that we're getting out from the U.S. and China next week. That can drive maybe a little bit more volatility out of the yield marketplace. And then I also think that same inflation data can maybe drive some volatility into equity markets as well.
All right, earnings next week. We'll continue to watch and see if some of these pressures start to surface in their comments. Appreciate you joining us here. Sean Cruz, contributor here across the TD Ameritrade Network. We're going to take a quick break. Stay right where you are. When you come back, my chart of the day, Kevin Hinks joins us to review some of our paper money trades this week. Lots more futures after this short break.
Hard to find, like catching lightning in a bottle. In uncertain times,
The platform demo webcast series is designed for knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the Watchlist at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
I'm Jenny Horn. Here's a few of this morning's pre-market movers to kick off the trading day. UBS lowered its rating on HP to neutral from buy while maintaining a $40 price target, roughly in line with the stock's closing price Thursday. According to the firm, weakening consumer demand for HP's products and a high valuation will likely limit gains for the PC maker going forward. HP shares are up nearly 24% over the last 12 months, outperforming the S&P 500's 9.8% gain, which is another factor contributing to UBS stepping to the sidelines. Bank of America upgraded Kroger to buy from neutral, while also raising its price target to $75 a share from $61. The updated price target implies a 25% upside from Kroger's closing price Thursday. An analyst at B of A said they expect broad-based inflation to increasingly drive consumers to retailers with more variety as individuals shift part of their consumption trends towards value. Food prices rose in February roughly 8% year over year, according to the Bureau of Labor Statistics. And a B of A analyst downgraded UPS to neutral from buy with a $204 price target. Within his transportation coverage, he sees deteriorating demand outlook and rapidly falling freight rates. He said freight market signals have turned increasingly soft, suggesting demand is waning, not due to capacity being added. This has been your TD Ameritrade Network Market Update. Now back to Futures with Ben Lichtenstein.
Welcome back to the Future Show here on the TD Ameritrade Network. It's time for my chart of the day. Let's dive deep into crude oil. I think it's going to be a focal point for many as we head into the end of the week. The dip we've seen, and well, I want to point out how we're now back down below the 50-day moving average. This is the third test of, and starting to come down below that $100 level. Again, we haven't really been below the 50-day moving average with anything in terms of any duration or time spent since basically the middle of November. If you remember, we broke back up above it end of December into the beginning of the year as we ran up into the $130 level. Keep in mind, crude oil topped out here at 130 as some of the geopolitical tensions and some of those worst-case Putin scenarios seem to get shelved a bit. You can see we've pulled back, as mentioned here, by about $33 off that high right now as we speak at 96.93, while up on the day by about 1%. Again, a lot of the Strategic Petroleum Reserves news this week and last week have helped. And, well, in addition to that, take a look. The U.S. dollar, which has been inching higher. I've got crude oil in this instance. It's the purple line. You can see it's come off that 130 level. And, again, a lower high as of recent. And coincides with the dollar, which in the candles you can see up and through to 99.98 right now as we speak. It's currently trading up on the day by about 0.25%. And the reason I bring the dollar into the discussion is because, well, in the weeks past, it seems like with geopolitical tensions, again, front and center on minds of traders and investors, that dollar bid activity was kind of, took a backseat role. If that's going to continue to be the case in terms of the run up here and, well, not only the impact that the dollar could have on commodities. Let's bring in Kevin Hinks. He's the host of Fast Market. He's joining us this morning. And Kevin, welcome. Thanks. Happy Friday. As I look at the dollar on the move higher, I oftentimes think about the impact this could have on indices, especially large caps. We've got earnings coming up next week. Maybe, well, inflation will be something we'll hear from many of the CEOs talk about. But I'm also wondering, we'll start to hear something about the greenback as it's now nearing this 100 even level.
Yeah, there's a lot to go through, Ben. You know, usually when you get a week that is light on economic data like this week was, the week after that's usually very heavy on economic data.
Next week will be.
That's what you'll see next week, right? Yeah, CPI Tuesday, PPI Wednesday, retail sales Thursday. Then you've got a bunch of secondary ones like consumer sentiment, business inventories, industrial production scattered throughout the week. So, but three big ones next week. CPI, PPI, and retail sales should give us a really good look at inflation and a really good look at the U.S. consumer as well, Ben. So, yeah, there's a lot going on there. Inflation will be the one that's in focus, as always, Ben. Remember, this is the CPI next week that we're looking at that might be some scary numbers because of when the breakout of the war between Russia and Ukraine happens. So, we'll see. Some of the expectations will be quite volatile, Ben.
Yeah, good point here, Kevin. One of the first numbers we were actually going to see crude oil prices on the rise, and has certainly pushed back some of that talk about how we could be at peak inflation levels at this point.
Sure.
Be interesting to see. And we were talking with Larry Shover earlier. He mentioned take a look at the core numbers because we may be able to discount some of the energy numbers if they continue to come off. Kevin, earlier in the week, we had a couple paper money trades. Well, throughout the week, for that matter. I wanted to look back at one, the NASDAQ. We put it on Monday. We were looking for a move lower off recent highs. We got a sharp move higher on Monday to begin the week, but then for the most part, kind of struggled throughout the week. We're trying to rally back this morning a little bit. I guess I'm kind of wondering if you could just sort of take a look back with us at the mindset headed into this one, review where things stand right now, and then ultimately if anything's changed in terms of what we need to do as far as managing this position.
Yeah, remember, Ben, this was a longer dated, long put vertical financed by two shorter dated short call verticals. So what you get, what you've got is a short call vertical, the 15,200, 15,300
right?
Call vertical. Yeah, that is expiring sooner, right? So that one you could cover and then reestablish that in order to establish that theta, right? Remember, we love to use short call verticals to finance long put verticals and short put verticals to finance long call verticals on the other side. So you've got two things going on here, Ben, but we have had some of the movement in the right direction for us, but even this morning we were up. Now the NASDAQ futures are sliding down here. So some interesting price action in this. Remember, this can be considered a directional play in terms of the NASDAQ or a hedge to a stock portfolio that might have long deltas. Either way, Ben, we're still trading the micro NASDAQ future. So it's a smaller contract nevertheless, Ben. So this is a bearish position that we're watching in NASDAQ. The NASDAQ is down. The futures are down this morning. Like I said, you're looking for that call vertical to expire and cover it at relatively low, inexpensive prices, Ben.
Does this require any maintenance at this point, Kevin? Any situation where we should be trading around or adjusting our strikes at any point?
Sure, you could go in at some point and cover the call vertical.
Okay, you said that.
If we get significantly away from where this is traded. Remember, we're 14,500.
Right.
We're short a call vertical above the market, 15,200. So as the risk reward gets misplaced, right? A lot more risk than actually reward left in the trade. Yeah, it's time to start trimming our risk and buy that in. Now, you could buy that call vertical in, reestablish another call vertical out in the next expiration cycle, and keep chipping away at the net debit you paid for the put vertical. Now, Ben, the first thing that you can do, if this has moved in your direction, is to take the trade off.
Okay, right? We always say that.
There's always that option as well. So you've got a put vertical that is now, it has moved, through our strikes or inside our strikes or near them, and you've got a call vertical that is expiring. So a lot of things, a lot of movement. You can always be moving around positions. Change the position, Ben, as your opinion changes.
I like that. Now, speaking of the opinion and kind of going back to the mindset when we put this trade on, we were talking about the NASDAQ, how it was rifling up into those Feb highs, again, up around this 15,200, 15,100 level, but it was also starting to roll over a bit. So we were like, okay, maybe it's maxed out here. Maybe we could start to work our way lower. And if we do, the mindset being the balance that we formed 15,200 down to 12,940 being the middle of the area that we're looking at. So we'll call it around 14,1380. If we accelerate through that, we could get some real big momentum to the downside or retest the low extremes. So the idea being here, I guess, we kind of, as I like to jokingly say, we boarded the train in New York looking to take it to California. Let's not necessarily get off in Chicago at this point, but I also just wanted to take a look here and just on the bigger picture chart, point out how the NASDAQ recently back up above the 50-day moving average and working its way back down to retest it. So this is going to be interesting to watch here, Kevin, and I agree with you with rates on the rise here right now and everything that we have going on next week, as you started off talking about. Let's keep this one on. We'll continue to watch it, and it'll give us something to follow next week as well, in addition to some of the other positions we have on. Kevin, thanks for joining us here this morning, reviewing the trade that we have on the micro NASDAQ. And, well, that's Kevin Hinks. Check him out throughout the day here on the TD Ameritrade Network. That's it for us here for Futures. Thanks for joining us this morning. Lots to come. Up next, Morning Trade Live, headed your way next.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads, like counters and diagonals, are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our Income Investing course. In the Income Investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Morning Trade Live. It's Friday, April 8th. Happy Friday. I'm Caroline Woods filling in for Oliver Rennick. We have a lot to get to today, so let's get started with what's coming up in this first hour of the show. We'll dive into the economic recovery and how the Fed is planning to combat inflation. We have a bunch of analyst moves for stock movers today, including Target, UPS, and Kroger. And we'll go inside out on some stock picks, including Medtronic and Starbucks. Now let's check out what the futures markets are doing this morning ahead of the opening bell. We're looking at a mixed picture here. S&P basically flat, Dow up about 0.2%, NASDAQ actually turning a bit negative, down about 0.2%, and Russell flat again as well. Similar to how we started yesterday, investors sort of searching for direction, struggling to find it. So we'll have to see how this all plays out. But let's kick things off with Kevin Hanks, the co-host of Fast Market. Good morning, Kev. Happy Friday to you.
Good morning, Caroline. Happy Friday. Yeah, we have a little bit of a hesitant market to start our Friday. The NASDAQ was higher. Now it's drifted into low territory. Nothing really too far from the unchanged level, but 3 of the 4 markets up now. Actually, the E-mini has drifted down, but I would call these markets more unchanged, Caroline, than moving in any direction. You know, I was just talking to Ben Lichtenstein, and, you know, we had a very thin week in terms of economic data. Next week, though, not the case, Caroline. CPI, PPI, retail sales, 3 of our top 6 data points will come out next week, and we get earnings, of course.
So we'll have some catalysts to move this market higher or lower. But Kev, there's just been this tug of war between the bulls and the bears. What do you think? Who do you think will prevail given expectations for earnings and inflation, which we know that data comes out next week?
Yeah, this is why the term climbing the wall of worry is an effective term, right? Because basically what we have here is a thriving, strong U.S. economy with a strong labor market, 3.6% unemployment, good job growth, really low first-time filers for unemployment insurance in some of the high-frequency data. But, and this is a big but, Caroline, we've got worries about inflation, and we've got a Fed that is now all in attacking inflation. So that battle between these two heavyweights, the question that traders are asking themselves this morning is, can the stock market go higher with higher inflation and a rising rate environment? And the battle, between a strong U.S. economy and rising interest rates that frankly make stocks slightly less attractive, right? And towards bonds and yields that's safer investment. That is the heavyweight battle going on right now, Caroline.
Kevin, obviously you said it was a thin week of data, so those Fed minutes were extra important this week. We also had a ton of Fed talk, which I think kind of really induced the sell-off because of the more aggressive tone. But because we're shifting away maybe from the Fed, do you think next week when we start to focus on other things, aside from, of course, the inflation data, do you think in terms of what's priced in that at this point the market has come to terms with an aggressive Fed who isn't just going to raise rates aggressively, but also trim the balance sheet pretty rapidly?
Yeah, another question that traders are dealing with this morning is the run-up in yields, right? The sell-off in bonds and notes, the run-up in yields. Have we reached max, right? Have we discounted every move in interest rates? I mean, a 2.7 10-year yield discounts a lot of interest rate hikes, right? So where are we? What happens, Caroline? The scenario where maybe this market goes through the next 30 to 60 days with a Fed meeting in there and yields are still right here in 60 days, right? Wonder if we've discounted a lot of that interest rate. Well, that would probably be favorable for stocks if yields were to climb to this level and plateau up here. That's the question, and inflation will have a lot to do with that. Remember, Caroline, expectations for inflation next week are skyrocketing in terms of what we think. So is that setting up for a disappointment in terms of the overall level of inflation? Inflation is going to be really on the tip of everyone's tongue next week. Tuesday, we'll get the CPI data. That will be an extremely important data point for next week, Caroline.
Okay, so bringing it back to today, Kevin, what are your thoughts as we get ready to kick off the trading day today? As you said, it's pretty much flat, seeing a mix of red and green, but ultimately no big moves in the futures in terms of the equity indices. But given the kind of late day comeback that we saw yesterday, did that tell you anything about a shift in sentiment maybe?
Yeah, some of the downside pressure from Monday's sell-off and Wednesday's sell-off may be dissipating here. Now, you've got the NASDAQ drifting a little lower pre-open here as we're down, about 0.3% now. But this day will be a long day to play out. Let's see. I always talk about the last trading day of the week and the last hour of the trading day. I think from 2 o'clock Central Time, 3 o'clock Eastern to 4 o'clock Eastern, that'll be a pretty important look because it'll show what traders are looking for into next week. So how we end this trading day, how we end this trading week will be vitally important as to how we look to next week, Caroline.
All right, first we have to get to the opening bell, and then we can focus on that final hour of trading. But Kevin Hinks, always appreciate your insights. We'll see you later on Fast Market. All right, now let's welcome in the host of Futures, Ben Lichtenstein. Good morning, Ben. So continuing the conversation that we started with Kevin here, we're heading into this week, even with now the S&P and NASDAQ both negative, but even before when the futures were positive, we were still heading for weekly declines. So just kind of your take on the week's action and what we saw.
Caroline, good morning. I'd have to agree with Kevin's final statement there, most of all in terms of looking at today's action to kind of get a feel for next week's activity. And as we head into the cash open, kind of mixed. Traders have had a lot to digest throughout a week that's been, for the most part, kind of light in terms of economic data, but busy as far as price activity and, again, ahead of a very busy next week as well. Let's take a look first and foremost at the rally up off the lows from yesterday, a sharp move higher, and throughout the day session trade, basically, you can see how the ES ran from 44.44 all the way up to, again, we're talking up and through 4,500 again. Now, you can see throughout the overnight session, for the most part, kind of sideways and sort of rolling over here right now. That's why I'm a little bit concerned. We've gone from positive now to negative in 3 of the 4 majors. The Dow's the only one that's fractionally higher, but for the most part, hanging out around unchanged. So I don't want to make too much in terms of that, but it does seem like the rallies we've seen recently have been short-lived. A pretty good example of that. Take a look at the 60-minute time frame since the all-time highs back in January, up around 4,800, and how we've seen a series of lower highs. Now, this is what sort of raised some eyebrows into the end of March, the strong rally off the March lows and how we were able to take out the Feb highs. But notice here again, follow through above those levels. The Feb highs again up around 4,600 was somewhat limited. We started to roll back over and now seeing again a series of lower highs, especially if we roll back over here and take out the lows from this week. That'd be a bit concerning for the bulls. A step back from the intraday 60-minute shows the daily time frame still holding above the 50-day moving average in the ES as the other threes are kind of teetering at or below. So kind of a mixed bag there. Similar situation in terms of the ES right around the 200-day moving average. Russell's well below it. Just a quick look at here you can see small caps have been struggling to get up above that key average. But I just wanted to point out here, we've seen VIX come off from the March highs, if you remember, up around 3650. We actually took out the March lows to begin the month of April. But again, with the indices kind of coming off recent highs, end of March highs, you can see the VIX is inched back off those lower levels. So something to watch here, but a lot for traders, for investors to keep an eye on, and a lot in terms of headlines to focus on into next week, whether you're talking eco data or ongoing geopolitical tensions.
And also in terms of headlines, the 10-year yields continuing to make headlines. It's up today, what, to 2.71. What do you draw from that? Is that concerning? How much higher do you think it can go?
I think, again, a trend to the upside in the case of rates. Treasury futures to the downside can continue a lot longer than we think is possible, especially with all this debate about peak inflation. Crude oil, again, is backed off, bound below $100 a barrel. But, you know, in addition to rates on the rise, we've seen some interesting activity with the dollar, which has really started to take note of the move higher here in terms of yields as well. And let's just begin there, and then we'll tie it back to, as you mentioned, rates to the upside. Here you can see the dollar up and through 100 even. Look at this. We're talking to new spring 2018 highs here. So again, we're talking or 2008 highs, multi-year highs here in terms of some of the price activity that we've seen, bid activity in the U.S. dollar. Now here's a look at it on the daily time frame, again, as it's been working its way higher here. And then I also wanted to point out, it's interesting. Well, actually, I wanted to, before we get into the rates relationship, I've got the futures on the right and the dollar index on the left. Just a reminder for those of your viewers who don't have access through the platform for the futures contract, again, /DX, just dial up $DXY. So you'll be able to take a look at the index here and the rally we've seen, again, off lower levels earlier, begin the year 2021 down around 89, and throughout this year we've been on the move higher in a big way. Take a look here though, because now I've got the dollar on the right and 10-year or 30-year yields on the left. As you mentioned, the run-up that we've seen, rates on the rise, it has me a little bit concerned about the expectations that the Fed would be able to navigate a soft landing. I also just wanted to take a little bit of a different look in terms of this dollar relative to rates here. And here's another chart. You can see both have been on the move higher. They've been firming up. So it really just speaks to me a couple things. One, the hawkish tone that we've seen from the Fed recently, and ultimately how the dollar is a safe haven. It's a sought-after currency amidst geopolitical tensions, unease during times like we're dealing with. And when you look at some of the weakness we've seen in the euro currency, the yen, it's not surprising to see the greenback strengthening here. We'll keep an eye on this relationship, though, because, again, commodity prices, which have been elevated, feed into all of this, a strong dollar and higher rates.
Okay, so we have a higher dollar, we have rates on the rise, and we have equity rallies that are short-lived. So what conclusions do we draw from this?
I think the conclusion here is that investors have kind of shifted from that mindset where, as we headed into the end of last year, it was kind of buy with both hands as we had the backdrop of earnings, really strong backdrop there from quarterly results from companies. We also had investors able to shrug off some of the uncertainties based on really strong economic data. We've seen housing numbers which have slowed a little bit, strong labor conditions here, but a very aggressive Fed, potentially a bit of a headwind from some of that sentiment that we saw into the end of last year. And while I don't think we're necessarily headed into a recession at this point, I think the economy is very strong. I think there are some concerns. There's a lot of fear in terms of headlines. So risk, I think traders are looking at it a little bit differently as of recent, a little bit more selectively in terms of some of the stocks they pick. And again, I think if rates continue the trajectory that we've seen to the upside, that headwind that we've seen could increasingly become so in the coming weeks and months.
Well, we're going to talk about recession risk with our next guest, but I do want to ask you, you don't quite think we're heading there yet. So what is it that you need to see in terms of signals? Because we have been getting those mixed signals with the yield curve inversion last week that was very short-lived. We have a Fed saying the economy is strong enough to withstand a series of aggressive rate hikes, but then we have others calling for the Fed to push us into a recession. So I guess, what is it that you're tracking to know, okay, we're heading there, if we are?
Two things, and we'll get some insight next week, beginning next week. I think warning signs from CEOs, companies reporting quarterly results could be a little bit of a flag to fly, and that hasn't been the case as of yet. For the most part, outlooks remain very strong and signaling that the economy is as such. And then the other thing that I'd be a little bit concerned about is, do we start to see employers cut back on some of the hiring as rates, inflationary pressures start to take hold ultimately? We've seen a very strong labor market this week. Again, jobless claims, weekly jobless claims, we're talking to multi-decade lows here. So I think 1968 levels, if I'm correct, in terms of weekly jobless claims. So I think that is another factor to consider. If all of a sudden employers start to have to lay off workers because of some of the price pressures we're seeing and some of the constraints tied to higher rates, well, that ultimately could have a ripple effect on the economy and could signal that ultimately a recession would follow.
All right, we'll leave it there. Ben Lichtenstein, thanks so much. We'll see you a bit later. Coming up, we'll continue the conversation about where we are in this economic cycle and look into the Fed, how the Fed is trying to tackle the inflation problem. Stick around on the TD Ameritrade Network. Morning Trade Live. We'll be right back.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim Mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange, bringing you real-time market coverage and access to the biggest newsmakers on Wall Street. Don't miss Trading 360 and the Watchlist live from the New York Stock Exchange.
Welcome back to Morning Trade Live. I'm Caroline Woods in for Oliver Rennick. It's time to welcome in Milton Ezrati, Chief Economist at Vested. Good morning, Milton. Appreciate you joining us.
It's a pleasure to be here.
So we're continuing the conversation that we were just talking about with Ben, our previous guest, about some of these mixed signals that we're seeing about the economy. We talked about the yield curve inversion. We talked about the Fed saying one thing, but economists forecasting another. But we also have, of course, inflation at 40-year highs, a strong labor market, and consumer confidence that's waning, especially about future expectations. So where do you stand in all of this? Do you think there are more economic headwinds or tailwinds at this point?
I think the tailwinds are fading and the headwinds are growing. That's not a very optimistic view, but that's the way I see it. Where we've had a very strong recovery from the lockdowns. That's pretty typical of any economy that's had an artificial constraint. You remove the constraint, and we have largely removed it, and you get a spring back. But that's slowing, and when we've caught up, I reckon in the second half of this year, at the latest, then we're going to slow down to trend growth, which is going to look very disappointing compared with the numbers we've seen in the past year, especially for employment. And then we have the inflation and what the Fed is doing to cope with inflation, both of which are headwinds for this economy.
So the headwinds are growing. What's the biggest obstacle we're facing in terms of the economic recovery right now?
Right now, I think it's the inflation itself. Inflation has a very distorting effect on the economy. And so it will work recessionary forces all on its own, even if the Fed were to pretend that it wasn't happening, which it did most of last year. Even if the Fed were to pretend, so that could build. It would take a while before it had its recessionary effect. We'd have a stagflation, and then we'd have a recession. But if the Fed is true to its word, and it's talking tough, it's not doing tough, but it's talking tough. If it's true to its word, we're going to have rates move up very smartly over the next few months, and that itself could create a recession. The Fed has tried many times in the past to generate a soft landing, and usually, not always, but usually fails.
So in terms of inflation, though, the Fed is no longer ignoring it. It's no longer in the transitory camp. We know that. But it's not also just a matter of suppressing demand, because we're in an environment with supply chain issues and commodity shortages that are likely to continue for a while. So are you confident that the Fed can even tame inflation with rate hikes in this environment?
Well, it certainly complicates the Fed's job. I think that as the economy slows, and we've already seen some of this slowing, you know, we got some very good employment numbers a couple of weeks ago, but not even 2 weeks ago, when the Labor Department released its March review. We got some very good numbers, but they were far slower than we had been seeing. So we're already seeing a slowdown. That slowdown itself will alleviate some of these supply chain problems. And so that will make some of the Fed's job easier, but it's not necessarily a good sign for the economy. So yes, it complicates the Fed's job, and I don't envy Jay Powell, but the Fed has only one direction it can go for the sake of the economy, and that is raising rates, restraining credit, and slowing the economy.
I heard you say the Fed usually fails with the soft landing. So I know you said stagflation comes before recession, but ultimately a slowdown. Are you in the recession camp at this point? Do you think the Fed will slow the economy enough to push us into a recession?
I think ultimately the Fed's going to be forced to do that. Consider the path they have to go on. We have inflation rates now in the United States of 7 to 8%, depending on how you measure them. Right now, Fed funds are at 0.5%. In order to really have a constraining effect, the Fed has to raise rates at least to the rate of inflation, if not higher. That's a long way from now, and that's a lot of pressure. We've only seen a 0.25 percentage point increase, and people are saying the Fed's being restrictive. They're not. They will be restrictive if they're going to beat this inflation, and I think they're going to do it. That's going to have a tremendous restraint. I would say, given the way the Fed's moving and how long historically it takes for inflation to have its recessionary effects, I would say we have 18, 24 months before we start seeing the real negative news.
So 18 to 24 months is pretty far out. But I think also, should we be looking at this a little bit differently? Obviously, we in the media can also be guilty of this, but we treat recession as this big bad word. But should we be looking at it as just a normal part of a healthy economic cycle to just right-size things, or no?
Well, it is a normal part of the cycle. It's not healthy for the people who get laid off during the recession, certainly, but it is a normal part of the deal. I wouldn't call it an ugly beast. It's certainly less pleasant than a boom, but I wouldn't call it an ugly beast. The economy needs adjustments from time to time. There are always excesses. This inflation happens to be a sign of a huge excess that's been going on for quite a while. I know the White House would like to blame it on supply chains. The White House would like to blame it on Putin, but it's really because we have been very free with money creation since 2009. So we have a fundamental adjustment here, and it's going to have to be worked out. And unfortunately, a recession is going to be a part of that one way or another.
But not for 18 to 24 months. And we have a very tight labor market, and we have a very strong consumer. Yes, confidence is waning, but we're not necessarily seeing that in the here and now in terms of how they're spending and what they're spending on. There's still a lot of pent-up demand. So at what point do you think we see that start to hit consumer demand?
Well, I think the ISM report we got just a couple of 3 days ago, a little more than that. The ISM report we got said that even though prices are rising, consumers and buyers are still enthusiastic. So we have seen some abatement in the pace of hiring. We have seen some abatement in consumer confidence. They are aware of the dangers of inflation, even if it's only an intuitive understanding, not an explicit understanding. So their confidence is down, but it takes time for these things to have effect, even the Fed raising rates. And that's why I'm saying an 18 to 24 month horizon, barring another shock. I think that's reasonable. That's a long time if you're a day trader, or even if you're thinking quarter to quarter. My point of view, or I'm trying to look at the sweep of the whole economy, it seems like tomorrow, but everyone has different perspectives.
So what specifically are you keeping an eye on? We were talking about some of those signals, obviously the yield curve inversion. Also, you know, we talked about this week the Dow transports being lower, which could be a leading indicator and point to a recession. But what specifically are you looking at to know, okay, a recession's coming?
Well, I think there are two steps here. One is when we start seeing more historically normal rates of hiring, more historically normal rates of growth in areas like consumer spending. We